So, as we scheduled today, we are going to discuss about, we are going to practice a few questions from a topic named corporate reconstruction. Corporate reconstruction or restructuring. See, there are three types of restructuring discussing in our syllabus. Number one, financial restructuring. Financial restructuring. That means the organization might be in some financial distress. Financial reconstruction or financial restructure means the financial position of the organization might not be that much pleasing for many of the stakeholders. So we are trying to get a better financial position, mostly by adjusting the capital structure. So financial restructuring means we are trying to adjust the we are trying to get a good financial position. See, financial position means, is it P&L or balance sheet? Financial position means, is it P&L or balance sheet? No comment. It is balance sheet, right? So we are trying to, our balance sheet financial position is not at all good. It's not at all pleasing for many investors. There's a chance that, or due to the financial destruction or due to the financial distress, the organization might end up with liquidation. So we are trying to readjust, we are trying to restructure the capital structure. So financial restructuring means we are restructuring the capital structure. Capital structure means it consists of, or it is the structural relationship between what all items. Capital structure means it is the relationship between what all item. It is the relationship between debt and equity. So most of the case, the company might be highly geared, highly debt. So the organization is not able to find new financing for new upcoming projects and all due to the current capital structure position, current capital structure financial position. So we are trying to reduce the gearing and to get a better financial position. That re-engineering is said to be financial restructuring. See, in exam kit, one of the most matching questions for financial restructuring is Fluftoad company. This is a wonderful question. If you didn't done this, please do practice this in order to get a core idea on financial reconstruction, financial restructuring. You could practice this question, financial restructuring. Have you practiced this question? Could you please confirm yes or no? By commenting yes or no. Have you practiced this question? It is a question to prepare a financial position based on the financial restructuring scheme provided by the management. We need to follow that. There will be some more share issue. There will be some writing off of the debt. So based on the details, we need to prepare a new balance sheet, new financial position, and we need to comment on that financial position, whether is it now that restructured financial position is pleasing for every stakeholder, major stakeholder like equity holder, preference holder, debt holder. In case of debt, there will be a tradable debt and bank loan, etc. One of the other restructuring, second restructuring is portfolio restructuring. Portfolio restructuring. This is what we are going to practice today. Like many of the new questions are from portfolio. There are many number of good questions from portfolio restructuring. There are different types of portfolio restructuring. One is spin-off. Spin-off means one department or division is splitted or demerged, we can say demerged from the mother company and created new company without change in shareholders, without changing shareholders. See, if I make an example from this, 1 second. Yeah. See, assume this is a company named mother company. Assume this is a company named mother company. Mother company consists of 3 departments or divisions A, B, C. Now we decided to spin off this division to a separate company. Now we'll create a separate new company. Now the old company will be A and B only. But the shareholders of this company and this company will be remain same. Whoever is the old shareholder, they are continue to be the shareholder of the mother company and the new spin-off company. There is no change in shareholders. We, instead of merging, we split it off into a separate company. This is said to be spin-off. You got it? What does it mean by spin-off? Please do respond. Could you please confirm quickly? Yeah. One of the other portfolio restructuring is sell off. See, I was discussing about portfolio. One is spin off. Next one is sell off. Sell off means we are selling a department or division for cash, not for share. It's a cash sales. We are selling off an department or a division. These two could be a numerical question. Spin off and sell off could be a numerical plus theoretical question. But we have another theory named as MBO versus MBI, management buyout and management buy-in. There is a technical article on this. Please do read if you didn't studied about this technical article. This could be a theoretical question worth 5 to 8 marks. So there was a technical article in the ACCA website. Please do read, make it as your homework. Have you done reading about the technical article of MBO versus MBI? In my normal sessions, I would deliver this as a topic itself. But if you didn't study this as a topic, you have to at least read the technical article. Have you studied this topic, MBO versus management buyout versus management buy-in? Please respond yes or no. Yeah, good. So this could be an theory question, but the spin-off and sell-off could be a theory. It can be a starting numerical plus theoretical question. So we are going to focus on these areas, spin-off and sell-off. There is one more restructuring, which is very probability is very less getting question. Only once this is tested as a theoretical area, which is organizational restructuring. This is just we are changing how the organization is structured, how the organizational departments and structure. It could be a department-wise functionalization, or the organization might be set as a functionalization, departmental versus functionalization versus divisionalization. So this is a very least examined topic, but the highly tested is portfolio restructuring in the new exams. Second is financial restructuring, and I'll say third chance for organizational restructuring. Having said this, we are going to practice a few questions. Today, I'm focusing on 2 questions named Hanwood Shoes and eView Cinemas. This is a similar type of question. So we'll be starting with Hanwood Shoes. Have you done these questions? Hanwood and eView Cinemas. Could you please Confirm yes or no? Have you practiced these questions? Yeah. So as we done in the yesterday last days last days practice session, we've been doing 2 to 3 questions together to get that flow how to answer. Similarly, we are going to do this question again. Okay, shall we try? Whether you might be done this question, but I'm going to show you the easiest way, the tricks that we could be used to solve a corporate reconstruction question similar to this. There are other questions also here in section A also. If I'm not wrong, Chakula was a similar question. Chakula in section A. This is also a similar question, similar to that Handwood and what EView cinemas. Okay, so please do take page number 110. That means it will be around 140. Question number 6. It is in 60. Please do carefully go through the scenario. In exams, we will be starting with reading with what the requirements, but will be, as it's a practice session since tutor is here, we are focusing on reading the scenario. Carefully read. See, as an if you booked for a normal exam session, that means not for a remote exam session, you have the luxury to write or scribble down some points in your pen and paper. So while you're reading, please make which company, which division is spin-off or which division is going to be sell-off, what is the rate given, is it for the continuing business or is it for the spin-off business. You have to be very careful about which data is provided. Okay, so you can take good time, around 5 to 10 minutes you can take, but I want to experience the thorough reading with making basic notes, which company, which industry, beta is given. Is it given of the, is that beta of spin-off company or is it the continuing business? You have to be carefully read and make some basic notes. Are you ready to do that? Are you ready to do that? Could you please comment? Practicing with the exam techniques. Yes. So read with your pen. That's what I always keep on saying. Read with your pen. Read and write it down. Some key points, which company, which industry, spin-off, sell-off, betas, WAC, cash flows. Make some basic notes. I'll wait. Once you're done reading, in comments, let me know, done. I'll wait. You all went through the scenario. Here, I'll give a quick debrief on the scenario. Handwood shoes were into two business, I mean, two divisions. One was their core, which is actually they started, which was children's shoe. And a few years back, 15 years back, they started with adult. Now they are seeing some good opportunity for adult shoes. So they are planning to spin off or sell off the children's shoe division. If you spotted from the question, is it a spin off or are they planning to sell it off? It's a sell off questions. It could be sometimes in order to get a better financial position, they will create a separate company to get a separate balance sheet. That might also some events that might work. So you have to carefully read whether it is a sell off or spin off. Here it is sell off. They plan to sell off. Now, a typical question like this will ask to calculate what is the expected selling price. What is the expected selling price? This is the requirement number 1. And after selling the shoes division, children's shoe division, that means it will continue with only adults division. What will be the balance sheet after that? Statement of financial position. And after that, we need to forecast what will be the earnings per share. The question might also ask to what might ask to calculate the effect in WACC as well. This is a maximum. It could be after using the balance sheet, we need to comment on the gearing as well. So these are the questions we could be expect from a typical sell-off or spin-off question. we need to calculate the expected selling price if it's a sell-off. If it's a spin-off, we need to value the new business. What is the value of the new spin-off business? So it's a business valuation, valuation of equity. This is a valuation of equity. Then we need to prepare the new SOFP, and we need to calculate the effect in EPS. We need to calculate the effect in WACC. Then we need to discuss on, after that, we need to discuss on whether is it a good decision or a negative decision to sell off. Is it going to be a positive or negative to each of the stakeholders? We need to comment on the figures what we calculated, plus we need to comment on non-financial factors. So this is a theoretical question. It is worth 7 marks and 13 marks are for that numerical. Okay, having said this, as I said earlier, we will be doing 2 questions together in order to get that flow. Now, hope you guys are comfortable with the scenario, right? Is there any confusing points? No, right? Every adjustment is straight away adjustment. I want to read you guys. See, I want to make a feel that at least, see, we'll be discussing a sell-off question, sell-off type of questions. We need to make sure that if this comes in the exam, we will score great marks, not just pass marks. We are going to earn a great marks. So, in order to be ready with the methodologies, please do read the scenario of eView cinemas as well. I'll wait. See, question reading is also part of practice, right? Am I right? Question reading is also is a part of practice. Am I right? Are you agreeing with that? A good reading is actually half done with answering. Am I right? So we'll be doing these 2 questions together. Now, please do read very carefully eView cinemas scenario. Not the question. Please read eView cinemas scenario. Yeah, I'll wait. I'll wait. Please do read eView cinemas scenario. Once you're done reading, let me know in comments that you are done with reading. I'll wait. And as I said earlier, read with your pen. Read with your pen. I'll wait. So hopefully you guys went through the scenario. Is there any similarity? Is there any similarities in this scenario? What's your say after reading the scenario of eView cinemas? Is there any similarities? Yes. Yes, it is. See, previously it was adult and children shoe. Here it is club and cinemas and club. So they decided to sell off the cinemas, and the requirement is same. We need to calculate the expected selling price. That means business valuation of equity, and we need to demonstrate the impact on SOFP, and we need to forecast EPS, and we need to discuss about WACC, estimation the WACC. Okay. So it's again, we need to, plus the theoretical question, we need to say the positiveness and negativeness of selling of this decision to sell off the eView clubs. Okay. So having said this, we will start doing Hanwood together with the, which question? The other question, what? eView cinemas. So Hanwood, I'll create a sheet for Hanwood, and I'll create a sheet for eView cinemas. eView cinemas. Okay. So Hanwood company, we need to calculate for question A, expected selling price. Expected selling price. Expected selling price. Please do with me. Okay, we have to do this together, otherwise we won't be having sufficient time. So Hanwood Shoes Company, the expected selling price, they said the sales price of the children's shoe division is the sum of the present value. That means they are using the future cash flow method. So they already given the future cash flow from T1 to T4. This is given. T1 to T4 is given. And after 4 years, it is expected to increase this much. And do they mention about the cost of capital? Do they provide them with a discounting rate? It is given, yes, they given it as 10%. It is given as 10%. So using the cash flow based, what is the concept of cash flow based valuation? Any items today's selling price or market price will be equal to the discounted present value of its future cash flow using a discounting rate. So T1, do right, T1, T2, T3 and T4, till T4 only. Till T4 only. The future cash flows, expected cash flows are given. It is 76, 81, 85, 76, 81, 85 and 88. This could be discounted at discounting rate, relevant discounting rate. They said it is 10%, 0.1. So present value of future cash flows from T1 to T4. We have that NPV formula. We have an NPV formula to calculate the present value. I'm just going to type that formula. Hope you guys know. It's T1 to T4. My mistake. It's T1 to T4. Is equal to, the formula is starts with an equal to NPV bracket open, equal to NPV bracket open, rate comma cash flows from T1 to T last. This is the formula we have to use in order to calculate the present value of any cash flows which is starting from T1. Okay, so this is the present value of futures cash flows from T1 to T4. But the business will continue for an foreseeable future. That means it's a perpetual cash flow. So we need to calculate present value of free cash flows from what to what? From T5 to which period? If you know, please do comment. T5 to which period? It's a business. Business will continue till which period? T5 to infinite. That means Tn. Infinite means Tn. So we'll be using a perpetuity formula. I'm just going to type the formula first. Present values will be perpetual cash flow into 1 plus G divided by R minus G. So this is the formula for normal perpetuity with growth. But since this is starting from T5 only, is it an advanced perpetuity or delayed perpetuity? Since it's starting from T5, is it an advanced perpetuity or delayed perpetuity? It's a delayed perpetuity. So for perpetuity formula, if it's a delayed, we need to multiply with discounting factor also in order to adjust for that delayed timing. The discounting factor has to be the discounting factor of a period which is just prior to the cash flows were began. In this question, perpetual cash flows are starting from T5. So the preceding period, previous period is T4. So discounting factor of T4 has to be taken. If you are not okay with this formula, at least do by heart this. This is a very, very commonly tested formula. Not only for reconstruction, valuation, NPV, there are many times this is actually asking. Okay, so perpetual cash flow into 1 plus G divided by R minus G multiplied by the discounting factor of fourth period. So I'm going to solve this formula now. Are you okay with the formula? Could you please confirm? Are you okay with the formula? Yes? Yeah, good. So perpetual cash flow, which is going to continue, is 88. This is the cash flow for the T4. So from T5 onwards, this is going to grow by how much percentage? This is going to be grow by 3.5%. They assumed it. So multiply by 1.035. This is perpetual cash flow into 1 plus G. Divided by, in brackets, R discounting rate is 0.1, 10%, minus G 0.035. So I'm done with perpetual cash flow into 1 plus G divided by R minus G. Now I need to multiply by the discounting factor of fourth year. The easiest way to calculate the discount, normally it is 1 divided by 1 plus R raised to 4. The easiest way will be multiply by 1.1 power of negative 4. Either you can take 1 divided by 1.1 power of 4. Instead of 1 divided by, you can just multiply with 1.1, but the power has to be a negative 4. This is the formula for easiest formula for discounting factor. The same answer you will get if using the normal discounting factor. Normal discounting factor is 1 divided by 1 plus r is to n. Instead of 1 divided by 1 plus r is, I'm just take the ulta by taking the negative of the same. So 1 plus r power of negative n. Okay, so this is the present value of infinite. Adding these two, this is the expected selling price. Are they expecting any premium for this? No, they said just the present value of cash flow. So this is the expected selling price. Expected selling price. Expected selling price of which division? I forgot to write that. Expected selling price of shoe division. So I'll wait in a few seconds in order to take your doubts. If you have any doubts, you can ask now. I'll give you a few seconds. Meanwhile, those who couldn't complete, they can complete as well. I'll wait for a few seconds. As I said earlier, we'll be solving two questions together. Now we'll go to the eView Cinemas question. We need to calculate the similar thing. Question A. Expected selling price of which division? If you done reading properly, you can easily answer. Expected selling price of which division? It was cinemas and club. Question, we can use the NPV Excel formula. See, expected selling price, we are selling off which division? For eView Cinema, they are selling off the club division, gym club, right? Club. Expected selling price of club division. See, this is an amended question. Previously, there were no marks for professional marks in section B. Now we have 5 marks for each questions for the professional marks. That's why they in order to adjust the marks, they directly given the expected selling price. See, they said, you can read here, the current value using the WACC 12% and based on the assumption that cash flows will grow by 5.2% in perpetuity, 6139 is the current value of club, that is directly given. So value of equity of club is directly given. How much it is? 6139. It is directly given in the question, 6139. See, this question is asking one more additional thing to calculate WACC, the change in WACC. That's why in order to give marks for WACC, they reduce the steps for the business valuation part. They directly given the figure. But in this question, are they expecting any premium? Are they expecting any premium for that? eView Cinemas is looking to obtain a 25% premium on the expected selling price, the valuation. So their expected selling price will be increased by 25%. So 6139 multiplied by 1.25. This is the expected selling price. This is the amount what we are going to realize as cash if everything going to happen which as stated in the question. So we are done with the calculation of expected selling price for the eView Cinemas. Is it okay? Now we'll again jump into the previous question, handwood question. We'll be doing both questions together. You have to make that balance. Okay. Shall we continue? Shall we continue?
Yes, sir.
Please confirm, everyone. I'm waiting for you. I already given sufficient time to read both questions and I given sufficient time to write it down. Now we are doing together. Yeah. So I'm again back to jumping to handwood shoes. What is next requirement in the handwood shoes in question A? Question A first was to calculate expected selling price. We done with that. What is next? What is next? We need to show the impact on SOFP. SOFP. See, in latest exams, the exhibit will provide with the balance sheet format. The exhibits, the answer response already includes a statement, a question with a balance sheet. We can copy paste that balance sheet. From the question, we can easily copy to our answer Excel sheet. But here we have to prepare, the same format, of the balance sheet, current balance sheet. So we are going to prepare the balance sheet now. Forecasted or SOFP, I'll say SOFP just after, not after 1 year, just after sale of this was children's shoes. SOFP just after sale of children's shoes. So what all things they have in the balance sheet? They have non-current asset. I'm writing in a minimal in order to save the time. Okay, non-current asset. They have current assets. Then using these total assets. Then they got share capital. Then reserves. These two parts, the total equity. I'm not doing that subtotals in order to save time. Then 9% is loan note. 9% is loan note. Then 7% is loan note. Then bank loan. Then current liabilities. Okay. After preparing this basic format, could you please read adjustment number 3, 5, 6, 7, 8 once again. 3, 5, 6, 7, 8 once again. I'll wait. Please do read once again the same adjustments. 3, 5, 6, 7, 8. I'll wait. Okay. See, adjustment number 3 is about the profit of the children's shoes division and the profit of the entire company, Handwood Shoes. This is the profit of the entire company. This is for that calculating earnings, profit after tax. And this is the hint that how we are going to use the money, the money what we are supposed to receive through the sale of children's shoe division. They said they will pay off 9% loan note. This will be cancelled. And some of the money will be invested in current assets in order to increase liquidity. Rest of the money they are planning to invest in what? See, first out of the money they received, first they will cancel off loan note, pay off 9% loan note. Then they will invest some money in current asset. Then again they will invest balancing amount, in which if you done reading properly, you could easily find out that. First they will pay off this, then in order to increase the liquidity, they will invest in current asset. And finally, whatever the balance figure, they will invest in what?
Non-current assets.
Okay, that's about that sentence. Plus, there are some profits. See, we are selling off a division. Profits has to be calculated. How we will calculate profits in a sales transaction? We'll take the difference between the proceeds and carrying value. Carrying value of the assets compared to the proceeds what we received, we will say it's a profit or loss on disposal. That has to be, profits and losses will be taken to which line item? Assets or reserves or share capital? Profits will be directly taken to reserves. Okay. Now, then this is the carrying values. These are the carrying values of the sold division. This could be used to calculate the profit or loss, plus this could be used to calculate the figures of current assets and all. Now, this is the additional return. See, we are investing some money in current assets and non-current asset. That additional investment will provide us with an additional return. Okay. Then this is about tax. Now tell me, do they mention anything about share capital? No. Do they mention
No.
about 7% loan note? No. Do they mention about
No.
bank loan? No. Do they mention about current liability? No. That means if they didn't mention anything, that figures are not going to
Change.
change. So the easiest way to prepare the forecasted SOFP, you read the adjustment. Whatever figures doesn't have adjustment, we will fill it first. That's the easiest thing, right? Am I right?
Yes.
So do fill these figures. Like share capital, there is no issue of shares, there is no cancellation, buyback of, there is no buyback of shares. So the share capital will remains as same as current. How much it is? The share capital is currently is 50. So it will remains as 50. And 7% is loan note. It is 145. Bank loan is 108. 145 and 108. These will remain same. Similarly, for current liabilities, this also remains same, 894. 894. Okay. So this is the easiest thing. We have to solve first. Have you done? Have you done?
Yes, sir.
Quickly. Now, do the same thing. Do the easiest formatting and identify whichever item doesn't have any change and fill it for which question? Which question? For which question? We are doing two questions together, right? Try the same for EView cinemas. Try yourselves, I'll beat. See, I want to make you guys confident that you can easily do this. SOFP, just after sale of club. I'll wait. Try yourselves, and after doing that, in comments, let me know done. So I'll show you how to do this. Hopefully you guys done. I'm jumping back to again which question? EView cinemas. See, I'll create the same format as given in the question: non-current asset, current asset, and total assets. And we'll start with share capital and retained earnings. They said they have 10% loan note, 10% loan note. Then other loan note, bank loan, current liabilities, done. Yeah, fine. So after reading the adjustments, see, they are planning to pay off the 10% loan note similar to the previous question. They will, the expected selling price, the proceeds, they will use to pay off the 10% loan note, and remaining will be invested in current asset in order to increase the liquidity, and remain the balance figure they will invest in non-current asset. And the current book value of the non-current asset, it is 3790 of the EView club. Club doesn't have a current asset as they didn't mention it. This is their beta. Beta is useful for WACC calculation, and for WACC calculation we require VEVD. This is for that. And additional investment is this much. Plus, definitely they will be having a profit through sell-off. It has to be taken. If they didn't mention it, if at all it's mentioned or not, we have to take the profit. If any profit, we have to take into the retained earnings. So these are the figures. These are the figures that is going to affect due to the decision to sell off. So the other, like, we can easily fill it. Share capital, there is no issue or cancellation or repurchase of shares. So share capital will be remain same 1000. Other loan note and bank loan remains same 2700 and 985. Then current liabilities, it is 2166. 2166. Okay. Hope you done this similarly. Okay. Is it okay?
Yes, sir.
Yeah. Now again, I'm jumping back to the handwood shoes. First of all, we have to calculate profit or loss on disposal. Profit or loss on disposal as working note. So if this is not directly given, we need to calculate working note profit or loss on disposal of children's shoes. Profit or loss on disposal. See, what was the proceeds? Proceeds means this is the amount what we are getting, sales proceeds. This was the figure what we calculated previously. Sales proceeds. Sales proceeds is equal to the figure that we calculated here, expected selling price. 1217 is the expected selling price. Less carrying value of non-current asset and current asset of which division? Which division is solved? We have to take that division's carrying value, right? Which division's carrying value of non-current asset and current asset? Carrying value of non-current asset and current asset of children's shoe division. So it will be separately given. If at all the children's shoe has, if at all the children's shoe division had non-current asset and current asset, the book value of those will be directly given. It is actually stated in adjustment number 7. It is said in adjustment number 7. The non-current asset of children's shoe division is 608 and the current asset of the same is 349. So these are the figures what we sold. 608 plus 349. So we are actually sold off a division which have a book value of asset worth 957 and we are receiving an amount of 1217. Is it a gain or loss on disposal? Is it a gain or loss on disposal?
Gain.
So gain on disposal. Gain on disposal is equal to 1217 minus 957. 260. This gain has to be taken to which account? This gain has to be taken to which account?
Reserves.
Reserves.
What is the current reserves? The current reserve till just before the sale of this division. It's 737, right? So I'm taking this as well. Whatever I'm done, I'm just taking. So 737 plus the gain on disposal. So this is the reserves. What is going to happen just before, not after 1 year, just before sale of the division. If at all they ask to calculate after 1 year, we need to take the profits of 1 year after running 1 more year. Can you try the same working note for the other question? Can you try yourselves? Could you please confirm? Can you try the same working note for the other? Yeah, try yourself. That's what I want. I'll show you the methodology, and once you're doing yourselves, you will feel more confident. Yeah, I'll wait. Hopefully, you guys tried yourselves. Here, I'll start a working note similarly. Gain, or it could be a loss on disposal of club. What is the expected sales proceeds? That's what we are calculated above, sales proceeds. It is 763. And so the carrying value of non-current asset and current asset of club. See, it is said in the initial paragraph. This is that question, EVU cinemas. Okay, here it is said here, the current book value of non-current asset of club can be assumed at 3790. So they mentioned about club has some non-current asset. They didn't mention about whether the club has current asset or not. If they didn't mention any figure, we'll assume they don't have any current asset. We'll assume they have only non-current asset. So we are selling off the non-current asset of 3790. This is the figure what we are sold in from the books. Okay. Is it okay? Did you understood?
Yes,
See,
sir.
there's no actually current assets directly said in the question. If at all they said current assets also for the club, we will definitely reduce that. Since they mentioned nothing about current asset, we are assuming there is no current asset for the club. The entire company might have current asset, but for the specific club division, they don't have any current assets. So the gain, definitely it's a gain. Gain on disposal. Disposal. It is 3883. So retained earnings, what's the current retained earnings in current SOFE? They have retained earnings of 7917. 7917 plus this gain. Is it clear now for those who couldn't?
Yes, sir.
Yeah. Anil, could you please unmute and ask your doubt?
Value of clubs.
Yeah, this is the current value of equity, but we are expecting a premium of 25% more than the value. So this is the expected selling price. It is clearly said in the question.
Value of clubs.
No. This is the value of equity if you are selling off an item based on cash flow valuation. Balance sheet is based on other accounting standards, right? So for calculating profit or loss, is it based on accounting standards figures or is it based on cash flow discounting based FM valuation? These profits in our calculation is for balance sheet, right? We are going to add this to the balance sheet. So the figures has to be based on accounting or based on cash flows. It has to be based on what, Anil? It has to be accounting. This figure is based on free cash flow based valuation. This is the present value of cash flows that we are going to get if the business is continued. So this we can't take this figure. It has to be the carrying value in the books. What we record in the books, what we are receiving, difference between these two is the gain or loss. Okay. So I'm again jumping back to the other question, Handwood. Please do remember, you have to be very careful while I'm discussing the question, which questions we are practicing. Next, definitely there will be say some hints about current asset. Definitely they will say some hints about current asset. They said for this question, they said they will invest some money in, they will invest in some money in current assets. They will invest some money in current asset in order to increase the liquidity. And after investing, the current ratio will be how much? The current ratio will increase to 1.4.
1.4.
So I'm going to start a working note for current asset. I'm going to start a working note for current asset. What is the as per current FS? What is the current asset as per current FS? What is the current current asset as per current FS? It is how much? It is 909, right? It is 909. See, we are doing Handwood shoes. Out of this, we sold a division. Does that division had some current asset? Yes, right? 314. For this question, they had an current asset. So 349 is the less current asset of sold division. So this is the adjusted current asset has to be in the books. This is the current adjusted current asset has to be in the books. Adjusted current asset. This is has to be in the books. Adjusted current asset. But we are investing new investment. We are in new investment in current asset. They didn't mention about that. How much it is, they didn't say. Examiner didn't say that. But after investing the investment in current asset, They said current ratio will be how much? The current ratio will be how much? They said 1.1. So using that, we already know the current liability. Now we know the current ratio. We can easily calculate how much, what will be the new current asset. New current asset after investment. This is the figure what we are going to show in. This is the figure what we are going to show in balance sheet. This is the figure what we are going to show in balance sheet. Okay. See, they said, you know the formula for the current ratio. Could you please comment what's the formula for current ratio? What is my pen? What is the formula for current ratio? Could you please comment? What is the formula for current ratio? It is current asset divided by current liability, right? It is current asset divided by current liability. The formula for the current ratio is current asset divided by current liability. They said this is going to be how much? The answer is going to be how much?
1.1.
1. They said it is going to be 1.4, right? 1.4. 1.1 is for, I guess it's for EVU cinemas. We are doing solving for Hanwood. So after investment, in order to increase the liquidity, they want to increase their current ratio to 1.4. So current ratio answer is 1.4. And they said, we know that there is no change in the figure for current liability. Current liability is 894. We know that current liability is 1894 and current ratio is 1.4. Using this, we can calculate the current asset, the new current asset, right? How we will calculate the new current asset? It is equal to, therefore current asset is equal to how much?
894 into 1.
Multiply by 1 point. This is division, right? Division, if comes this side, it will be multiplication, right? So the current asset after investment, in order to increase liquidity to 1.4 of current ratio, the new current asset after investment has to be 894 multiplied by 1.4. Do you got this? Do you got this? How many of you understood this? Please respond. How many of you understood this?
Yes, sir.
Yes, sir.
So this figure is going to be in our balance sheet 12516. Using this plus as a balancing figure, we can easily calculate how much we are going to invest in current asset. See, without investment in current asset, after selling off this division, the current asset value has to be 560. The current asset value has to be only 560. Due to the investment, this is going to increase to 125, 1251. So we can easily calculate as a balancing figure how much we are supposed to invest in current asset in order to increase the current ratio to 1.1. So the investment will be 1251 minus 160. This is the balancing figure. Is this also okay for you guys? Could you please confirm? This is also okay for you guys?
Yes,
The
sir.
investment in current asset is 691 in order to increase the liquidity to 1.1 of current ratio. Now try the same working note in EVU cinemas and find out these figures and find out the current asset figure here. I'll wait. Okay. Once you're done, do comment. I'm waiting for that. Okay. So we'll try the same working note. For EVU cinemas. Okay, I just copy paste the data. As per current FS, what's the current asset figure? 2347. Is there any current assets of sold division? No. For this question, they didn't mention any figure. So the adjusted figure has to be 2347 minus 0. Now, do they mention about any current ratio similar to that? Yes, it is, right? They said they will increase their liquidity by investing some money in current asset so that the current ratio will increase to 1.5. Using this, we know that current liability, there is no change. So the current asset will be 2166 multiplied by 1.5, as similar what I discussed for the previous question. So this figure has to be here. And the balancing figure is the amount what we are supposed to invest to increase the liquidity. So the new investment will be 3249 minus 2347. 902 is the investment money. Is it okay?
Sir, once more, please.
Were you lost? Could you please unmute
Sir,
and ask? New investments.
Sir,
See,
new current asset after investment.
See, we have a current asset of 347. After investment, in order to increase the liquidity, to maintain the current ratio to 1.5, the current asset has to be 3249. So difference between these two is the balancing figure. This is the amount what we have to invest in new investment in current asset. Okay. Is it okay?
Yes, sir. Yes. Okay,
Yeah.
sir.
So to complete this, only we require the amount of non-current asset. This could be calculated very easily. See, look at here. One second. See, this could be easily calculated. Loan note is paid off. So the total equity will be sum of all these total assets and liabilities. Sorry, total equities and liabilities will be this much. Wait, don't write this. This total equities and liabilities. For the balance sheet, the total assets also has to be the same figure, right? The total asset also has to be the same figure. So as a balancing figure, we could calculate the figure for non-current asset. This is one way we could do. But listen carefully. In order to calculate the figures for next question, forecasted EPS, we need to know what is the amount we are going to invest in non-current asset. Look at here. We'll start a working note for. I am doing this for eView Cinema. Okay, eView Cinema, not for Hanwood. eView Cinemas. The same question I am continuing. Working note. Allocation of sales proceeds. Allocation of sales proceeds. Do together with me now. Write this working note. Allocation of sales proceeds. How much was the sales proceeds for? We are doing for eView Cinemas. Okay, eView Cinemas. Do check whether you are doing in eView Cinemas or not. Yeah. So sales proceeds. We know that it is 7673. This is the sales proceeds. First, we will pay off what?
Loan
Loan
note.
note.
So the 10% is, if I'm not wrong, it is 10% loan note, right? They said, yeah, this 10% loan note will be paid off. So 10% loan note will be paid off. So how much money will be reduced from this? 3,200. The loan money is 3,200. So it will be paid off. Second, they will try to increase the liquidity by investing in new investment in what? New investment in
Current assets.
new investment in current asset. This is what we already calculated here as a balancing figure 902. This is a new investment in current asset. Whatever the balancing figure, this is the third thing they are going to do. New investment in what? New investment in
non-current assets.
Current assets.
We got how we are allocating the figures and how much we are investing in non-current asset. Okay. Have you done till this?
Yes, sir.
Now, see how I calculated this non-current asset figure as a balancing figure, right? There's another way we could do this. What is the non-current asset in balance sheet? Current balance sheet. What is the non-current asset in current balance sheet? It is 15,621. Please do together with me, okay? 15,621. 15,621 is the current non-current asset. Do we sold some non-current asset through selling off of a division? Did we sold any non-current asset through sale of division?
No.
Yes, we sold some non-current asset. Look at here.
Yes, 3790.
Sold some non-current asset of disposed club, right? What was the figure of non-current asset of the disposed? It is 3790. There is no current asset for club, but for club we have non-current asset. So from the current non-current asset figure, this has to be reduced. 3790. Am I right? This 3790 will be reduced since it's sold. Whatever carrying value we sold, it has to be cancelled from the books. Plus, we are investing 3571. We are investing 3571. We are investing 3571 in the books. In non-current asset. So this is the figure. This is the figure. Same figure you can calculate in a different manner. Whether you calculate as a balancing figure or on this figure, you have to prepare this working note. You have to prepare this working note. Actually, this working note is not meant for calculation the non-current asset. Non-current asset could be calculated as a balancing figure. This figure is, this working note is for, the working note is for next question for EPS, for calculating EPS. Is it okay? Is it okay with the, we are done with the balance sheet. Look at here. We are done with the balance sheet. After you completing the balance sheet, let me know in comments that you are done. Based on that, we'll continue to the next question, Handwood. One thing, could you please try calculating the non-current asset as a balancing figure and prepare this working note and calculate this figure similar to this for Handwood company. You got, try yourselves these, the figure of non-current asset a balancing figure and using this working note. Using this working note, find out figure here also. Try yourselves. I'll wait. For Handwood company, if we calculate the figure of non-current asset as a balancing figure, we have to first of all calculate the total for equities and liabilities. So total for equities and liabilities will start from here, share capital onwards. So it is 2194. So the total assets also has to be 2194. So as a balancing figure, the figure for non-current asset will be 12151. If you solve the figure for non-current asset as this is acceptable. But only problem is we doesn't know how much investment in, what is the amount of investment in non-current asset, which is actually new investment will provide more return, right? If we invest new investment, which will give us more profit, that will increase our earnings, that will increase our EPS. Next question is to calculate EPS. In order to calculate increase in EPS, we require how much money we are invested in what also. We know how much money is invested in current asset. We require how much money invested in what assets also. Which asset also? New investment in which asset? Non-current asset, right? That's why we have to prepare. It's not for this in order to get this figure. For getting how much we invested in non-current asset, we require to solve this working note. So what was the sales proceeds? It was 1217. We are paying off some debt. Previously it was 9% debt in the previous question. For this question, it is 9% loan note. From the current FS, what is the figure for 9% loan note for Handwood company?
170.
It is 175. So first we will reduce that. 175 is gone. Remaining we will invest some money in current asset, new investment in current asset. That's what we calculated in the previous working note. So whatever left, that is the money we are investing in non-current asset. Okay, so this is a figure we are investing in non-current asset. Using these figures also, we could calculate the non-current asset figure. This is equal to what was the figure in balance sheet currently? It was 1,200. Less we sold and non-current asset worth 957. That's reduced. Plus we invested 350. So the figure will be 5. Did I miss anything?
Sir, not 957. Current asset, not current asset.
What was, okay, it is the both combined figure, right? What was the non-current asset figure? It was 608. 608. So less 608. Yeah. So 942. You'll get the same answer. There might be some rounding off. That's okay. Hope you guys are comfortable with this.
Yes, sir.
So what was the, I'm going back to the requirement. We solved, calculate the expected selling price, SOFP. Now what's next? Forecasted EPS. Forecasted EPS. Shall we continue? Quickly let me know. Shall we continue?
Yes, sir.
Everyone. Shall we continue?
Yes, sir.
Yeah. So now we are trying to calculate the forecasted EPS. So forecasted EPS. Forecasted EPS. We need to know what's the current data. 1 second, I'll write EPS only, EPS, so that I know what is the current and what is the forecasted. Current and forecasted. What is the current profit after tax? What is the current profit after tax in first year in current situation if we doesn't sold the shoes company, children's shoes company? They said the total after tax profit of the entire company in coming year, if the children's shoes is not sold. So if the children's shoes is not sold, we are expected to get 217 in current situation. Am I right? Am I right?
Yes, sir.
Yeah. So in forecasted also, I'll start with 217 and I will reduce less profit after tax of sold division. Profit after tax of sold division. They directly given. But was the predictor after tax profit of shoes division? That's a children's shoes. That's a sold division. In year 1, it is how much?
76.
So after sale of sold division, the profit will be, that much profit will be reduced from the organization, right? Since we sold that division, we will lose a profit of 76. We will lose a profit of 76 from the sold division. Is it okay? Is it okay?
Yes, sir. Yes, sir.
Yeah. Now we sold this division. Using that money, first what we done? Using that proceeds, first what we done?
Loan notes.
Loan.
Paid off loan note. See, if we paid loan note, that means we will save interest on that loan. So add savings on redeemed or paid back loan. What was the figure of loan? What was the figure of 7% loan note? 9% loan note. This is a 9% loan note. It is 170. So we paid a 175 million worth debt, and we were paying an interest of 9% on that. Since we paid off that, we can save that interest what we were paying previously. On this 217, we were paying this much interest. Now it is saved, so I will add back to that. But do remember, whenever there is interest comes with a tax effect. So in order to make it to after tax, net of tax, the tax rate is how much? Tax rate, they said how much? It is 20%. Net of tax, in order to take net of tax, we have to multiply by what percentage?
80%.
So add savings on paid back, add savings, interest savings, right? It's not savings. What savings? Interest savings on paid back loan, net of tax. Okay. Net of tax. This is what we done first. Then after that, we invested in what? We invested in the second and third, we invested in what? With the proceeds,
Current asset.
we paid first, then we invested in current assets and non-current assets. If we invest, if our investment increases, we can expect return on that figure, right? So
Yes, sir.
add return from new investment on non-current asset. This also has to be net of tax. This also has to be net of tax means 1 minus T. Similarly, we need to add return from new investment on what? Current asset as well. See, in order to solve this figure, we need to open this working note, correct? We need to know how much we invested in non-current asset. Without knowing, we are not going to get this figure. So this is equal to, we are investing 350. We are investing 350.46 in non-current asset. Am I right? We are investing 350.46 in non-current asset. Definitely, they will mention what is the percentage of return. The additional investment in non-current asset, here it is, 8th adjustment, additional investment in non-current asset is expected to earn 18% before tax. So we invested 350, it provides an 18% return. It provides an 18% return before tax. We have to pay 20% tax on this. So the increase in income after tax will be how much percentage? After tax, the increase in investment will be how much percent? We have to pay 20% tax. After paying that tax, the increase will be how much?
80%.
80%.
Similarly, we invested 691 in current asset. Here we can say it is 691. On this figure, we can expect 6% before tax. So multiply by 6%. In order to make after tax, it is 80%. It is 80%. Okay. So this is the earnings. This is the earnings. Here it is 217 itself. In order to get EPS, now we require number of shares. See, what was the current number of shares from the balance sheet? It is said how much? 50. They didn't mention what is the share capital par value price. See, if we are assuming 1 per share, the number of shares will be 50 here, 50 here. If we assume it is half, par value is 0.5, then 100 here, that means 50 by 0.5, and here 50 by 0.5, the numbers will be same. Since there is no increase in share, new issue or new share issue, the number of shares will be remain same. So it is best to assume it is how much? Par value is 1. So if we assume par value is 1, the number of shares will be 50. Then EPS will be 217 divided by 50 and 237 divided by 50. So the EPS is going to increase. The EPS is going to increase in EPS 4.74 minus 4.34. This is the increase in EPS if we sell off the unit. This is what we are supposed to calculate, impact on EPS. Impact on EPS after sell off, the EPS will increase. Did you got it? Could you please confirm?
Yes, sir.
Yeah. Now try the same. For which question? Now try the same for which question? EView. You might be find little difficult to calculate this figure for EView cinemas. In exam, if you are not getting a single figure, don't wait for that. Just assume, at least calculate other figures, right? So for EView cinemas, if you are not able to get this figure, that's okay. Try to calculate other figures. I'll wait. Did you understand what I mean? What I mean to do from your side? Did you understood? This is a little tricky figure. since it's said in, they didn't give us a separate figure, they said in some percentage connections. So you might, a few students might be confusing here, but no need to, if you are not getting this, just leave it. You just calculate the current PAT and other figures. You just calculate other figures. Is it okay? Is it okay? Did you understand what I mean to do?
Yes, sir.
Yes, sir.
Yeah, okay, try. I'll wait. I'm just going to solve quickly for this same for this EVU Cinemas question. For the current and forecasted. Okay, current and forecasted. Super. So what's the current profit after tax of the entire company from the question?
8 to 5.
The profit after tax of this is club, right? Clubs is given. Okay. Oh, the other I actually missed it. This
The
is
opposite.
given 454. They didn't mention about the current, right? They said this is the 40% of the total. This is the 40% of the total. So what will be the total current? This is equal to, this is a 40%, right? So in order to get total, this will be multiplied by 100 by 40. 100 by 40. In order to get the total, it will be 100 by 40. See, I'll explain once again. If you draw a circle, this consists of cinemas and club. This comprises total. Club, they said it is 454, and they said it is 40% of the total. Total will be 100%, right? So using this 40, we have to calculate the total. So 454 into 100 by 40. This is the fraction in order to calculate the total. Is it okay? If we have 40%, if we have total, as if we have total, how we will calculate 40% of the total? It will be, if we have total, it will be 40 by 100. Since we don't have the total, we have only the 40 value, we'll take the ulta, 100 by 40. Is it okay? Is it okay, everyone? Could you please confirm?
Yes,
The
sir.
total will be
Yes, sir.
454 into 100 by 40. So this is the current total. And the same will be here. So this has to be reduced, right? This has to be reduced. So in order to make it positive, I'll create and put a negative. So this is the figures. Now, what is the interest savings? Interest savings will be, we paid off this loan of 3,200. So 3,200 multiplied by, we were paying a 10% on this. So we save this interest, but we will be losing 20% tax savings on that. Is it 20% again, tax rate?
Yes, sir. Yes, sir.
Yeah, so the net of tax, it will be 80%. And we have an additional investment of 3,571 in the non-current asset. And we can expect a return of how much in non-current asset? They said 12%, which is before tax. So multiply by 12% in order to get after tax 80%. Then for current asset, we are investing 902 in current asset. And we can expect a return of 7% before tax for current assets. So multiply by 7% into 80%. And the total will be the earnings and number of shares. We could be easily picked from the balance sheet. They said share capital of 1,000 and the par value is 1 itself. So it will be 1,000 here and here. So the EPS will be 1130 divided by 1,000. Here,
Sir, oops,
is there any difference in
earnings is 1135.
1135? What happened? Where did I went
In
wrong?
current
Current
earnings.
Okay. I said, yeah, instead of copy paste, I just put equal. So it will be here, yeah. Is it okay now?
Yes, sir.
So the impact in EPS, there's an increase in EPS, 1.33 minus 1.15. Yeah. So this will be the figure for that. Okay, since the time is over, I'm just complete this question. See what is left in EView cinemas. EView cinemas, we need to calculate the impact in WACC. Impact in WACC using the current and forecast. I guess current might be given, or else we need to calculate forecast. And this is we need to see this. This is a similar repetitive question from the sell-off point. Plus, see after ending this session, please try to solve this WACC. If you are not able to solve this WACC, just refer to their answer. Plus, you should read the decision. I mean, the comment part. The comment part. Like easily, I can say a negative of sell-off is a negative of sell-off is we will lose what the opportunity of benefits from diversification, right? See, we were previously invested in club and cinemas. We were invested in adult and what children's. By selling off one division, we will be less diversified. More diversification, risk will be reduced. If risk is controlled, the WACC will be reduced. There are a lot of benefits we are getting. So while this is demerging, not demerging, we are selling off a division, right? This will reduce the opportunity of what? Reduce the opportunity benefit of benefits of diversification. Are we becoming after sell-off? Are we becoming more diversified or less diversified after selling
Less
off?
diversified.
Less. So
Yes.
there are general comments that could be used in any sell-off question. See, always you will get marks if you write up to the scenario, but after reading the answers for discussion part of EView cinemas and Hanwood company, definitely you will get 2 to 3 points, at least 2 benefit and at least 2 positive and 2 negatives from reading that comments of Hanwood and EView cinemas that could be used in any sell-off question. So please don't stop here. Since my time is limited, I'm going to stop this. Go continue this through their answer and identify some points that could be used in any sell-off question. Okay. Having said this, I'm just going to stop this recording.